Good morning, and welcome to the second part of the three-part Ayala-FINEX Finance Summit for 2020. The future is fraught with uncertainties. We're facing radical changes, not just because of the pandemic, but because of geopolitical tensions, technological breakthroughs, social schisms, uh, environmental changes, and even lifestyle shifts. And so today's theme, our theme for 2020's summit, cannot be any more relevant or timely, reimagining the future and leading through the unknown. We're very privileged to have two guest speakers and two panelists who will share with us their view of the future of the increasingly volatile, uncertain, complex, and ambiguous world. To start our program, I'd like to invite you to join me in a short prayer. Almighty Father, we pray for the Ayala Group and FINEX, members of their respective organizations, and today's guest speakers, panelists, program participants, and all our summit attendees. Rule over us each day and keep us safe and free from harm. Let your word dwell in our minds and truth in our hearts, so that in all we say and do, we may think and feel only what is good and just. Keep our eyes focused on the road you wish us to tread. Keep us alert and vigilant, so that we may not be waylaid by temptations and mindless distractions. Cleanse our hearts of all impurities, so we may live honestly and see the good in others. Grant us peace and serenity in the face of turbulence, chaos, and noise that assault our senses. Enrich our lives with meaning and lead us toward our life's purpose. Give us your grace and blessing and envelop us with the warmth of your love always. Amen. May I now request you to put your right hand over your heart and join in the singing of the national anthem. To formally welcome us to today's summit, I'd like to call on Omar Cruz, FINEX Vice President for Professional Development, for his opening remarks. Omar? Omar, you're on mute.
Thank you. Thank you for that. Good morning to all. Again, welcome. In behalf of FINEX, Financial Executives Institute of the Philippines, I'd like to welcome all the participants to the second session of the 5th Ayala-FINEX Summit. We trust you are all well and safe, and thank you again for attending the series. In the first session, Jaime Augusto Sobel dwelt on reimagining the future, focusing on three aspects. The first, rethinking how we reach our customers. Second, redesigning how we work and operate our companies. And third, revisiting and renewing our commitment to society. This perspective and framework give us a good idea on how to deal with this fast-changing market environment in the pandemic. In this second session, Mr. Cezar Singh, President and Chief Executive Officer of the Bank of the Philippine Islands, will dwell more on how customers are reached, specifically in banking, through digital transformation and e-commerce. While Mr. Oleg Timchenko, partner of McKinsey Company, will discuss the future of work in this new environment. We also have panelists who will react and comment on these key presenters. We have for the first panelist, Mr. Felipe Pupi Estrella, Executive Director of Ayala Corporation and the Group Chief Financial Officer of Ayala Corporation Industrials. And the second, Mr. Mike Gurin, who is the Executive Vice President of FINEX and Partner Advisory for KPMG RG Manalbat and Company. All our speakers and panelists will be properly introduced later. We hope you find this second session as interesting and as engaging as the first. Have a great session. Again, welcome to the Ayala-FINEX Summit, and thank you again all for attending.
Thank you, Omar. Let me just very briefly introduce our two guest speakers before they take the floor. After reading the CVs of the two speakers, I couldn't help but ask myself a few questions. Are high achievers born or made? What is the stuff that these gentlemen are made of? What drives them? How are they able to stretch each day to 25 hours and each week to 8 days? Consider the following. Our first speaker, Cezar P, graduated from De La Salle University with a degree in AB Economics Accelerated Program, magna cum laude in 1979. The next year, the following year, he acquired a Master of Arts in Applied Economics degree from the University of Michigan, Ann Arbor. Mr. Kunsing joined BPI in 1981 and in 1985 moved to JP Morgan and Company based in Hong Kong and Singapore, where he rose to become the head of the firm's investment banking business in Asia Pacific 12 years after. 2 years from then, he became president of JP Morgan Securities Asia Pacific, a position he held until 2004. He then moved to the Rohatyn Group and for the next 9 years was partner and head of the Hong Kong office in its private investing business in Asia. In 2013, Mr. Kunsing's career went full circle and he was back in BPI where he started, but this time as president and CEO, a position he continues to hold to this day. He is simultaneously chair of BPI's Thrift Bank, Investment Bank, UK Bank, Insurance, Leasing, and Rental subsidiaries. He is also director in a string of other bank subsidiaries. In parallel, he's also president and director of BankNet, chair of the Philippine Dealing System Holdings and its 3 operating subsidiaries, and chair and president of the Bankers Association of the Philippines. On top of this professional involvement, he sits on the board of 4 private companies, one listed company. He's also a member of the Trilateral Commission, a global discussion group, director of the U.S.-Philippine Society, and trustee of the College of St. Benilde and Manila Golf Club. Quite a bit on his plate. Our second speaker, Mr. Oleg Timchenko, holds an MBA degree from Wharton School of the University of Pennsylvania, where he was designated Palmer Scholar for outstanding academic achievements. He also holds a Master of International Economics degree from the National University of Kiev. Mr. Timchenko has worked with a number of banks in emerging markets on a wide range of topics, including business strategy and ecosystem building, advanced analytics, organizational design and culture, productivity improvement, and credit process redesign and risk modeling, all areas that are needed to navigate these increasingly turbulent and very uncertain waters. Mr. Timchenko is a partner in the Manila office of McKinsey Company, where he serves clients in the banking and telecom sectors. He joined the company in 1999 and has since crisscrossed the globe, having worked in Russia, Europe, the Middle East, Southeast Asia, and North America. I'm sure we're all excited and eager to listen to our speaker's presentation. So let me now call on and let us please welcome Mr. Cezar P. Bong, you have the floor.
Good morning, Mary Lou. Thank you for the very kind introduction. And thank you too for the FINEX and Ayala for this distinguished invite. I will talk a little bit about the topic I've been given to me, reimagining the future, leading through the unknown with BPI as the focal point, and with digitalization in particular as the area of emphasis. Let me start with on page 3 of our presentation, just to give you a little bit of background about our bank. Marisa, next page. Yes, here. Here I just want to show you what our network and client base looks like. About 9 million clients in all, about 1,200 branches if you include the 300 branches we have in our microfinance unit, about 2,800 ATMs and cash acceptance machines, and at the end of last year, over 21,000 employees. The way I'd like to look at it is 1 out of every 7 or 8 pesos in deposits and 1 out of every 7 or 8 pesos in loans in the whole banking system are accountable by us. And the other thing worth mentioning when you look at these ATMs and CAMs is they were truly cutting edge back in the 70s and 80s. BPI was the first local bank to have it. At that point, it was considered cutting edge. Today, these ATMs and CAMs are pretty much just hygiene. If we move to the next page, just very quickly, we offer a broad array of financial offerings. On the retail banking side, where we have BPI Family Bank, we're number 2 or number 3 in mortgages and auto loans, depending on kind of the day and the month. Corporate banking, I'd say we're number 2 or number 3. Business banking is really for SMEs and MSMEs. For these clients, we just raised the 10 billion peso COVID bond. On the microfinance side, Banco, it's a 3-year-old entity. We've grown it by 100 branches a year over the last 3 years. It's now the 2nd largest microfinance lender in the country. On the asset management side, I think we're number 2 in terms of AUM. Bank assurance, if you look at premiums on the life side, we're number 3 or 4. And if you look at the non-life side, we are the most profitable non-life insurance company. And we have a reasonably large leasing and rental business. But now to go to the heart of the presentation, really today we face all kinds of challenges as banks. And really, I just list them here, the 8 challenges that most come to mind. You know, prior to this crisis, it was really fintech as a big challenge, regulation, cybersecurity, and interest rate levels, specifically declining interest rate levels. If you go back to the global financial crisis over 10 years ago, 2008, 2009, that was a crisis that really started with the US banks. They had overextended to mortgages and to other bad loans. And the reaction of that was for central banks around the world, led by the Fed, to really increase the pace of regulation. So the cost of regulation that banks faced since the global financial crisis has just gone up and up and up. And that has eaten into bank returns. Secondly, what the central banks did in order to help us recover from the global financial crisis is they injected a wall of liquidity into the financial system. There was just so much liquidity put in, and that had the effect of lowering interest rates. And as you well know, banks do well when interest rates are at moderate levels. When they're too low, margins begin to shrink, and that becomes a real challenge. And then fintech. Fintech really stepped up after the global financial crisis. And what fintech companies did is they attacked the areas of banks that were least regulated, specifically payments and remittances. Okay, so banks began to lose market share to fintech companies. And finally, cybersecurity. Okay, all of a sudden, as technology became more prevalent, cybersecurity began to be a real issue. So these were, I think, the four things that I consider to be key challenges even prior to this crisis. Now, come the COVID crisis, we now have to deal with, challenging work arrangements, people coming in and out, rotating workforces, etc. We have to deal with loan losses, okay? It's no surprise that NPL rates are coming up as borrowers are having a harder time servicing their loans. We have to question what is the role of branches now, especially if digitalization is going to step up. And then we have to deal with the need for financial inclusion, because notwithstanding COVID, which I think in the short term will slow down financial inclusion, in the long term, we still have to achieve the financial inclusion objectives of society. Now, I think digitalization can help address many of these challenges. And I think they can help address maybe 5 or 6 of these challenges by lowering the cost to serve, by allowing security of finances, by allowing for accessibility, and by lowering infection rates, okay, with the use of digitalization. So we'll talk about digitalization a little bit at length for the balance of this report. If we go to the next page, by most measures, I think our bank's digital platform is among the best in the country. We have almost half of our customers enrolled in our digital platform. A quarter of our customers are active users. And by active users, I mean they're using it every week. Some of them use it every day. Some of them use it 10, 20 times a day, believe it or not. And when you look at the BPI app, the finance app of BPI, it's now number 5 in the App Store. It's number 6 in Google Pay. It's behind only the fintechs, all right? And if you were to believe the surveys we get reasonably strong net promoter scores and customer satisfaction scores. But we are finding that customers always want, and frankly, they deserve more, okay? They want more online, they want more data, and they're more demanding. So we've got to continue to improve. If we move to the next page, this whole digitalization platform that we have today is really a step in what has been a fairly long multi-year digital journey. It started back in 2016, really from a lunch meeting that I had with my chairman, when we decided we wanted to be digital, and we felt that becoming digital, we could become much more financially inclusive. So it's a multi-year journey. Here I show you some statistics back from 2016, vis-a-vis where we are today. And I won't go through them line by line, except to say that you could see significant growth in all of these metrics. And you see significant growth, particularly in the area of the use of APIs. Application programming interfaces. A few years ago we had none. Now we have 136 in production. And on any given day, over 150,000 APIs are used in daily consumption. We came from a stage where a few years ago, we were dealing with just simply the automation of the back office and a distribution model that was basically branch-led. to where we are today, where we've digitized a lot of the front end, particularly in payments and remittances, and have to do more with other products like investments, account openings, loans. We've adopted a mobile-first strategy, and we now have a situation where we can retrofit our processes for the online and digital world, and we can achieve scale. So I'm not saying we're finished. I think we've finished with, if you look at these journeys, I'd say we're at 1.0. We're now moving to 2.0, but this is a process, okay? I vividly remember that the process itself is not necessarily a smooth one. One of the memories that that is very vivid in my imagination is the glitch we had in 2017, where our customers woke up one morning and their branch balances didn't match the amount of money they had in the bank. And that was a system glitch that was caused by human error. And I remember myself and some of my senior colleagues got hauled into Congress and tried to explain what had happened. And this was all part and parcel of the digital build-out. It was just one of those things. But we look at where we are today, and it's just a blip in this journey. If we go to the next page, our digital transformation really depends on 4 pillars. One is technology. It's the platform itself. And here we think in terms of NG, which is next generation, which is our mobile platform, and BizLink, which is our platform really targeted at corporates and SMEs. When you look at technology, technology represents 15% of the bank's costs. It's about 7 or 8% of the bank's revenues. So this is a big expense for us. If you look at people, we talk about training. We obviously have to train a lot of people with this digital transformation. We talk about hiring. We're always in the market looking for people with the right skill set. We are, as I mentioned earlier, a firm of over 20,000 people. 10% of our headcount, 10% of our headcount is directly related to technology. So that's big. When you think of 2,000 people just doing technology in our bank, that's a lot bigger than the sizes of many other banks that are out there. And then when you look at analytics, the need for insight, we talk about transaction trends. We have to figure out transaction trends. We have to identify opportunities. We have to make sure that revenue is assured. And here, we also talk about the need of harnessing data scientists. We are fortunate to have several dozen data scientists in the bank. We started hiring and training them 2 or 3 years ago. We hired and trained them in conjunction with the US firm United Health Group. They ran a phenomenal program for us. And we are so happy to have these data scientists in-house. And finally, journeys. We have to understand what our clients want, okay? Whether they're in the preferred segment or the mass market or they're corporates or SMEs. If we go to the next page, COVID-19 has really tested our digital platform. Before COVID-19, pre-ECQ, 78% of all of the bank's transactions were done digitally. And during the ECQ, at the height of the lockdown, 95% were digital. So only 5% of all our transactions happen in the branch. Today, with the lockdown eased, it's still 92% digital and ATM. So that's still quite large. And what we think is when we get back to whatever the new normal is, I don't think we're going to get back to pre-ECQ levels. I think the digital percentage of total transactions will still be very high, okay? Now, the trick here is to match the value with the volume. Because to be completely honest, the large value transactions are still done in the branches, okay? So if you look at total value, the branches create most of the total value. If you look at total volume, digital creates most of the total volume. Now, if we go to the next page, we basically tell you here that we think we did okay. We have done okay in COVID-19, but we really have to do a lot more. What we're seeing is we're getting 20,000 plus enrollments a week in our digital platform. And we're seeing remittances done digitally. We're seeing investments have begun to be done digitally. But we'd like to get to the point where we can allow people to open accounts digitally. We're almost there. We'd like to make loans digitally. And we'd like to build a deposit franchise digitally. We also see the need to decrease face-to-face interaction because of this crisis. So you'll see us using Zoom and webinars quite often. And then we have to think about our branch and manpower setup. Will it be right in the new normal? How should we reconfigure in the new world? If we go to the next page, I've talked about payments, and this is the first thing that most people, including ourselves, have digitalized. And the point I'd like to make here is if you look at August, August was the first month in Philippine history where InstaPay, and these are really the retail payments, where both InstaPay, both in volume of transactions, number of transactions, and value of transactions, overtook ATMs. ATM transaction numbers and ATM transaction volumes. So ATMs are still important, and ATMs represent hygiene in the banking system. But more people are using InstaPay today than ever before, nationwide. And if you look at the big four InstaPay participants, they're really ourselves and BDO, and it's GCash and PayMaya. And so you see there we're the number 2 in the receiving, we're the number 3 in sending, but it's really the 4 of us so far that have really been most active in this InstaPay environment. If we move to the next page, the trick here is to try to what we call do phygital. Okay, we think it's the future of banking. In the old days, 1 or 2 years ago, we enhanced our branches with digital features. So you'd walk into the branch and you could do things digitally, online, there was a little counter there. But now we tell ourselves we have to start with digital, and we should be able to deliver the physical customer experience digitally via Zoom, via call outs, via video conference calls. And we have to lead with mobile. That is our mantra today. If we go to the next page, I'd love to be able to tell you we dropped this all up. It's obviously not true. We think we do a good job of looking at other banks in the world and trying to figure out what they're doing. I list 3 banks here that we watch a lot. And these are all Asian banks, obviously DBS in Singapore, Siam Commercial Bank, and Kasikorn in Thailand. Outside the region, I'll tell you, we've gone to see BBVA. My COO and I spent a day with the CEO and the chairman of BBVA because they have done amazing things with their digital platform. And we look at Lloyd's a lot. And if you look at the current initiatives that we list down there, these are initiatives that, frankly, all banks that have made progress in the digital space have adopted. So this is not rocket science. This is not necessarily unique to us, but it is something. These are lists of initiatives that we are following through on. If you look at the next page, we think successful digital transformation has certain prerequisites. Number 1, you've got to innovate the products. And here we list NextGen, which is really for retail clients, BizLink, which is for corporate and SME clients, Banco, which is for our microfinance clients, And here we lead with mobile in each case. Secondly, you need talent because digital didn't start in the Philippines, right? So you've got to search the world and look for talent. And one real asset we have is we have a COO in Mon Hoc Son, who used to run IBM in the Philippines in the 90s, went off, did huge regional and global jobs for IBM. And he joined us 4 or 5 years ago, and he has been key to driving our digital transformation. And because he's been here, we've been able to attract so much talent locally and from abroad to help us with this initiative. We need open banking partnerships because we've got to use other people's platforms. We've got to bolt on other APIs. And finally, we need very, very good cybersecurity. You remember in the old days, if you wanted to rob a bank, you got a gun, you walked into the bank, and you held the bank up. And then, when ATMs really were big and systems became more important, if you wanted to rob a bank, you did it through skimming. So the theft was via the ATMs. The theft was tied to the devices. But look at how theft is being done now. Theft is being done via social engineering. It's no longer tied to the device. It's basically tied to the behavior of individuals. And so you need your cybersecurity must keep up with how people are trying to steal money. Every single day, we take down more than a dozen phishing sites. People pretending to be BPI or connected to BPI. If we go to the next page, what we're basically saying here is a few years ago, it was really all about China and a few select global tech players. But the success of early ecosystem plays has motivated incumbents, and we're an incumbent, and startups, say fintechs, to follow suit. So now we're in a world of multiple integrated ecosystems. We have one such ecosystem. We are connecting to other ecosystems. We are having people latch onto our ecosystem. If we do our jobs right, our ecosystem will be, frankly, useful and needed by all our customers, all right? Because we're better connected, because we have the technology, because the technology is stable, we will have a serious edge. Finally, and this is the last page of this presentation, we think a digitalized BPI will be ready today, and it will be ready for the future. Who knows what the future will bring? All I can say is it's getting tougher for banks. We have to focus on lowering our cost to serve. That means serving our customers. And that really speaks to operational efficiency, all right? Lowering OPEX. We have to lower the cost of funding. As interest rates have come down, as margins have shrunk, as interest margins have shrunk, we have to lower our cost of funding. And we have to lower the cost of our own mistakes. And how do banks make mistakes? They make operational errors and they give bad loans, okay? So we have to lower the cost of our mistakes. We think digitalization can help us do all of these three things. And that's why we are tying our future to it. So let me conclude by saying this is a journey. We think BPI right now is done with digitalization stage 1.0. We are moving to 2.0. I'm sure there'll be a 3.0 after that, but we intend to stay in front of this. Thank you very much.
Thank you, Bong. Let me call on our second speaker, Mr. Oleg Timchenko. Oleg, you have the floor.
Good morning. Thank you very much for the opportunity to share our thoughts on the future of work. We do live in unprecedented times. A year ago, no one or very few would think we would have a global pandemics, millions of people sick, billions of people working from home, tourism being a deadbeat business, and even NBA finals held in a Disney World bubble because of the epidemics. Nobody really could predict the impact of lives and livelihoods that the current epidemics would take. However, even before the pandemic, the future of work was drastically changing. Advances in robotics, artificial intelligence, machine learning were ushering a new age of automation. Machines outperform humans in a very wide range of activities now, including the ones which require cognitive capabilities. Robots and computers can not only perform a range of routine physical work better and more cheaply than humans, but they can make judgments, sense emotion, and even drive. These are all the activities which a decade ago considered to be difficult to automate successfully. We live truly in a digital age. Machines already took over the world. Skynet is here. By about year 2005, there were already more connected devices than humans. And we're on a trajectory of exponential growth in this difference. There are good things about that. All of you know about 6 degrees of separation. Well, the thing is, there are no 6 degrees of separation anymore. You are separated anywhere on the planet through the social networks from anybody else by just 4 people. We live in a much more connected world. There are also bad things. Daily emails globally outnumber the stars in our galaxy 3-1. And I guess we can all testify to the pressure all of those emails put on us. Most jobs are impacted by automation. What does that mean? About half of the activities for which people are paid about 15 trillion globally, USD globally in wages to do have the potential to be automated by adapting currently demonstrated technology. Activities most susceptible to automation involve physical activities which are highly structured in predictable environments, manual labor, as well as collection and processing of data, which is honestly a lot of what financial institutions do. About 60% of all occupations have at least 30% of activities that could be automated. Even fashion designers and chief executives have automatable parts of their jobs. We estimate that about 20% of their work could be potentially automated. There is no reason why a machine cannot scan a report and provide a very good TLDR synthesis. There's no reason why a machine fed with a large enough and good enough amount of data can inform decisions, prepare staff assignments, and so on. We find that there are less than 5% of all jobs are fully automatable. It's like sewing machine operators, which means that more occupations will change than will be automated away. More occupations will change. The work will stay, but it's gonna be a different kind of work. It's gonna be different kind of jobs. So what does this mean? If we look globally, close to 400 million people will need retraining in the next decade because their skills are becoming obsolete. In the Philippines, there are different estimates, but the consensus is the equivalent of 10 to 18 million jobs would be lost to automation. Clearly, the degree of this change and the pace of this change will depend on a bunch of technical, economic, and social factors. We do see continued technical progress in areas such as natural language processing, which is a big factor. But beyond technical feasibility, the cost of technology, competition with labor, performance benefits beyond labor cost savings, as well as social and regulatory acceptance will affect the pace and scope of automation adoption. We do believe that net in the Philippines will see a positive effect on the labor market in spite of the automation. Jobs in unpredictable environments, occupations such as mining or childcare will not be automated. Rise in incomes because of the automation and effectiveness and efficiency it brings to the economy, high spending on investment, which is long overdue in the country, investments in technology and marketization of previously unpaid work, such as childcare, will all contribute to the creation of jobs. So net, we do expect that automation will result in a positive, slightly positive effect on the job market. However, as I said before, the nature of the work will dramatically change. The potential of automation greatly varies between industry sectors. Let's look at this picture. In the Philippines economy, different sectors rate very differently insofar as automation potential is concerned. You have manufacturing on top, where close to 60% of activities can be automated. We have education and information and communication, only quarter can be automated. Finance is somewhere in the middle. Finance and insurance, financial services have automation potential of about 43%, which is clear a dichotomy of the types of jobs which are present in the industry. Some of them highly cognitive, highly relational, such as client service representatives, salespeople. Some of them are very routine, repeatable, and highly automatable, such as back office. Financial institutions are also moving very quickly on adopting edge technologies because these technologies help solve real-world customer problems. But that means that financial industry is actually moving faster than many others along the technology adoption and automation curve. Conversational bots, virtual AI, machine vision to process documents, biometric identification, real-time fraud detection, these are not the things from the future. These are the technologies which are used en masse by banks in Asia today. So what does it mean for the sector? We do believe that about 25% of the roles in finance and insurance will be fully automatable by 2030. 25%. These are largely back office positions, bookkeeping, data entry, as well as transaction processing in branches, which is basically tellers. A large portion of financial jobs will have a fair share of the activities which are automatable. So financial analysts, loan officers, they will have close to half of their activities automated, which is good because then they could focus on a more value-added activities, have higher productivity and larger impact. But now, for example, it takes, I don't know what the number for the Philippines, unfortunately, but it takes an average 37 days to approve a mortgage application in the United States. We do believe with application of currently existing technologies, this number can go as low as a week. And in the final scenario, by 2030, if technology develops at the pace it's developing now, we could see mortgage processing drop to less than 3 days. But of course, today's context is different than when it was before. Today's context is accelerating the need to enhance skills. And there are 3 changes I want to talk about. One is remote working is clearly here to stay. It's clearly here to stay. The new distance economy will require a new collaboration model and new types of leadership virtual leadership, leading people over Zoom screens, managing through trust and not direct oversight, maintaining a sense of purpose in the organization when most of the employees are working out from their homes. And finally, the recent changes, and Bon spoke well about the surge in digital demand. The recent changes create or exacerbate imbalances in talent supply and demand. Let's look at the remote work. Remote work is clearly here to stay because most of the employees want it, or at least some part of it. Most of the employees we polled, they do like working from home. They definitely don't miss their commute, although many regret the lack of private space where to run their daily job. But the new generation coming into the workforce, the millennials, they do value flexibility of work highly. So this shift, which we see with workforce only 5% working from home pre-COVID to 65% working at the peak of the lockdown, we will see a pullback, but will definitely not go back to the pre-COVID level. The corporations discovered that the fears of reduced productivity for majority of the positions have been largely unfounded. I spoke with many clients who basically commented after initial period of turbulence, they see that productivity is stabilizing and in many cases increasing what they were able to achieve in the office. Clearly, shareholders want it. Most of the companies, and we're polling companies on this topic, are looking to achieve 10 to 20% real estate savings as a result of reorganizing their labor forces. And customers want it because customers want digital interaction, which is on their terms at the time which is convenient for them, open 24/7, and puts them in control. Of course, people recognize that some of the key activities are better done face-to-face, negotiations, onboarding of new recruits and training, relationship building, critical decision meetings. Some of the crucial conversations, they have to be done face-to-face. So most advanced companies actually segmenting actively their workforces and planning in the long run when the epidemics goes down, how they will work, who will stay fully remote. Maybe SME sales force can be working in a hybrid mode, and who will be fully on site. As a result of those changes, we will see more and more companies adopting hybrid operating models. Again, polling some of the largest companies in the US, we find that only about 20% plan to kind of try and drive back to majority of people in the office model, while the remaining 80% are looking at some or variant of the hybrid model, whether it's a HQ hotel where there are smaller headquarters, which are combined with many employees working remotely, several local hubs spread around the city, and employees mainly work from home and come in hub for the crucial meetings, or the all remote work where pretty much everybody works from home and then facilities are basically rented as needed. There's clearly a shift towards more use of co-working and collaboration spaces, and then renting event facilities for large in-person events. There's a move to, as offices have to be refurbished to accommodate social distancing, to shift from traditional cubicle offices more to experience centers where there's a mix of meeting space, but also innovation labs and demo space for those industries which have to interact with customers on site. So the nature of the office is changing as well. Now back to the skills and how the supply and demand will change. Clearly, there is a short-term story and there is a long-term story. The short-term story is that in response to the pandemics, banks had to engage in a very rapid reskilling because the branches, 30 to 50% of branches were shut down and had reduced hours. At the same time, there was more demand. NPLs were growing, so you need more people in collections. In advanced markets, mortgage refinancing applications surged as interest rates went down, so needed more people were needed to process that. Banks had to train employees in empathy because more clients were distressed and they didn't know how to use digital tools and new services. And some banks even saw opportunities. Face-to-face selling model could not be in place anymore, faced disruption. So one of the international banks really invested in training their salespeople in virtual selling. And they now perceive that this is a competitive advantage because they believe that we are going to be in the remote mode, at least in some positions, for quite a while. If we look at how these skills will shift, and this is our forecast for 2030, we will see the reduced demand for physical and manual skills, and even for basic cognitive skills. Basically, being literate is not enough anymore. What is going to be in demand is, of course, technological skills. Organizations and financial institutions will need big data scientists, IT professionals, programmers, technology designers. There will be a higher demand for social and emotional skills. There's a debate to what extent those skills can be taught. Maybe empathy not so much, although it can be honed, but advanced communication can. And the largest growth in demand for social and emotional skills will be for entrepreneurship and initiative taking. Entrepreneurship and initiative taking. That is a big shift which is going to happen. More employees will have to step up, take ownership. They need to be given opportunity to do that. They need to be taught to do that. The environment in the organizations have to create the certain risk-free trampoline, if you want, to let people fall for them to take initiative. And then in higher cognitive skills, definitely creativity and decision-making will be growing in importance as machines will take over more routine information processing, but still making ambiguous decisions, coming up with new designs and inventions. This is a human trait which will be growing in importance. The next wave of automation will definitely have a sizable impact on the financial industry. Currently, globally in financial services, about 35% of employment in back office jobs, which are extremely susceptible to automation. So there we expect to see a decrease in total hours worked by 2030 of 25%. Tellers, accountants, brokerage clerks, these jobs will decline substantially. And the banks have to think strategically how to deal with this gap. Most of the top management we talk to, they agree hiring and renting employees will not be able to fill most skill gaps, particularly in the technology area. And I'll talk about this in a couple of minutes. There's no way to hire all the skills that we need. Reskilling is a priority. And you have to start thinking about what type of job profiles you will need to have 5 years from now and 10 years from now. Look where you're likely to get those. Look at the inflow of graduates. Look at the level of skills in your job markets. And fortunately, job market now has become a bit less local and a bit more regional and global. And understand what type of reskilling programs you have to run. Reskilling will also have economic and social benefits because it leads to lower hiring and separation costs, as well as leaving less people out of job. We do have an obligation to take care of our people. Finally, reskilling can be a critical success factor of the digital transformation. We do know that many transformations fail, and at least in 30% of the cases, it's due to employee resistance. It will be extremely hard to convince a person to help automate their own job if they are not sure about their future in the organization. That's one more reason why reskilling is critical for what we're trying to do. Now let's look at a couple of areas in a traditional bank which are going to be impacted by these trends. One, of course, is the branches. As I said, in the short term, because of the pandemics, 30 to 50% of the branches were closed or partially closed, and it's not quite clear how quickly they will resume normal operations. So traffic moved away from the branch, but there's growing demand for collections, call center work, financial advisors for more affluent segments. This is a near-term imbalance, but there's also long-term opportunity to fundamentally rethink the bank branch operating model and talent needs. We will continue seeing service transactions moving out of the branches. I'm fully with Bond. The pull back to pre-COVID levels in terms of the digitization will not happen. We're gonna stick with substantially higher, kind of closer to 90% transaction fulfillment through digital channels. We will have slower footprint growth. Right now, Philippines has about 80 branches for 1 million inhabitants. Canada has about 220. The footprint was growing in the Philippines. Definitely, it will never reach the developed market levels because digitization will provide much of the offloading, but there might be some footprint. Branches will be different. Branches will be more automated, and the employees in branches will be more versatile. So, as I said, we expect significant reduction in the demand for tellers, but the demand for universal bankers, essentially people who are able to do sales and service, and SME bankers will grow. And we've looked at the skills which those employees are missing today, and clearly there are some similarities. Digital fluency is lacking in both positions. Ability to do advisory sales, interact with the customer, understand their needs, and provide them with the best solution. And customer service skills, empathy, ability to listen. These are the groups of skills which will become much more important over the next decade, and that's where the investment should go, and that's where the reskilling effort should be targeted. There's no reason why a teller who already knows how the bank operates, some of the systems, some of the products, cannot become an effective universal banker. We should create different learning journeys which target, with all the new advances in our understanding of how adults learn, target them with a mix of traditional learning, which is training and digital courses, with non-traditional methods, more active peer coaching, learning networks, gamification on the job, nudging techniques, creative techniques to enhance growth mindsets. The companies which will do this well will do more than just close the skill gaps. They will use reskilling and their abilities, the newfound abilities of their workforces, as strategic advantages. Another area which is important to financial institutions is the tech, IT. And here there are a few messages that I want to share. Number one, there's no way the talent gap is possible to close in IT. These are the pictures for the US market, and on the left side, our rough estimates of supply and demand for tech-related positions in US banking pre-COVID, and on the right-hand side is accelerated digitization scenario induced by COVID. As you can see, even in a pre-COVID scenario, in an aggressive demand scenario, there was no way that supply would meet the demand. And in a post-COVID world, it's gonna be even harder. We do hear from our global workforce survey that about 40% of the managers, top managers, the companies expect structural deficiencies in their IT and analytics. And the way you should address is the following. You should hire. It's impossible not to hire, but you will not be hire everyone. You should really go and try to hire best in class. You need to bring a few external stars or unicorns, top engineering talent who would cascade down the best practices to existing IT talent. You should complement hiring with internal upskilling. For example, if you take a good engineer and you upskill them in business skills, they will make excellent product owners. You should be helping your legacy IT talent. You should help them to get the skills, development, full stack development to become a future-ready tech talent. And definitely IT is no longer separate in business from banking. IT is the business of banking. So IT talent across the board needs to be cross-skilled on business skills to be able to work closer with the business. When you do go out and hire and you hunt for those stars, a few things which we would advise, do become part of developer communities, go where the talent resides. The number of digital talents who are actively looking for a job now is very low. They will not come to you You have to go to them. You do have to have specialist HR recruiters who have at least a basic tech understanding, both to show credibility and assess candidates in early interviews. What we see is people are becoming more and more flexible with academic qualifications. 65% of people working in tech do not have a formal tech education. So you'd rather assess what a person can do than where a person has studied. And finally, as always, do hire people for their full potential and learning mindset. If they have that, they will learn on the job. We do need to redesign the future of work altogether. So I would encourage you to take some time when this webinar is over and think about a few questions. What effects is technology having on my institution and where we are on this automation journey? What jobs, skills, and activities will change in my company dramatically in the next 5 to 10 years? How shall we adapt the work? What do we change in the way of working when the COVID wave subsides, or maybe it stays with us permanently? How should we change the workplace and office design? And most importantly, how do we adapt the workforce? How do I build the right workforce skills? Where do I hire? How do I do reskilling at scale? And how do I build a leadership to drive these changes in my organization? I want to finish with a quote from Charles Darwin, who wrote more than 100 years ago, "It's not the strongest of the species that survives, nor the most intelligent. It's the one that is most adaptable to change." I wish we all could follow this rule and be very adaptable. Thank you.
Thank you very much, Oleg. And we will now move on to the reaction of our panelists. And before I give them the floor, let me just very briefly introduce our two panelists. Our first panelist is Felipe Estrella III. Mr. Estrella is an executive director of Ayala Corporation, who concurrently serves as president of Automotive Central Enterprises, the exclusive importer and distributor of Volkswagen and Maxus vehicles in the country, and president of Iconic Dealership, which operates dealerships of Volkswagen, Kia, and Maxus. He's also Group CFO of AC Industrial Technology Holdings, Ayala's holding company for businesses in electronics manufacturing, solar technologies, automotive design, tools and components, automotive sales and distribution, and motorcycle assembly and distribution. Mr. Felipe obtained his BS Business Administration degree from the University of the Philippines and his MBA degree from Columbia University. Our second panelist is Michael Arcatomi Guerin, a partner of KPMG, RG Manabat and Company. Mr. Guerin is a member of the firm's executive committee and head of the Deal Advisory Group. He oversees all M&A transactions, including due diligence and valuation work in the Philippine market. His clients operate in such sectors as financial services, healthcare, retail, energy, logistics, and media. Mr. Guerin obtained his BS Business Administration and Accountancy degree from the University of the Philippines cum laude. He attended the Asian Institute of Management's Executive MBA program and was a participant in KPMG's Chairman's 25 program in INSEAD, Singapore. So let me now call on Pupi for his brief reaction to the presentations. Pupi, you're on mute. You'll have to, there you are.
There. Thank you, Marilu, and good morning to everyone who's joining this webinar. I guess my reactions to Bong and Oleg's commentaries and sharing is full agreement with everything actually they've said. Truly, even in our industry, the domestic automotive industry, we are seeing the need to make radical changes to the way we do business, and the need to digitalize even some of our core activities. These obviously bring very interesting challenges and opportunities to myself and my colleagues as we try to reimagine how our business could be moving forward. And of course, just like Bong in banking, where they've seen a dramatic shift of activity to their digital platforms. We ourselves have begun to create those platforms and activate those platforms, and also interact with our customers on those platforms. So one of the things we've actually done is create an online portal for all our automotive brands. I will do a small plug: www.acmotors.com.ph. Check it out. You can see all our products online. You can study them, and you can make a reservation all the way to that point of the transaction. And hopefully, in the near future, we will see the process progress all the way to complete fulfillment. I guess I'll stop there for now, and back to you, Marilu.
Thank you, Pupi. Can we now hear from Mike?
Thank you, Malu. Good morning. So it has been a pleasure to be here, and it has been most satisfying to be listening to our featured speakers today and my co-panelist, Pupi. So we like to think that CEOs, and by extension, the companies that they lead, recognize that in order to succeed in the market, one can't go back to staying normal. So instead, there is an opportunity to define a new future. And three action areas will be very critical. They are sustainability, digital, and trust. So those three things. All three are definitely very crucial, and we can discuss them as needed during the actual panel discussion. But to be consistent with our main topic, I would like to focus on digital. The need for companies to go digital, very thoroughly discussed earlier by Bong, and the need to reimagine the future of work, as expounded by Oleg just now, boils down to the objective of satisfying the needs of an ever-changing customer or consumer. Each company has their respective value proposition that they would like to deliver to their target market. So on the next slide. Yeah, so if you'll allow me to discuss the trends that we are currently seeing as far as consumers are concerned. In order to do this, therefore, there is a fundamental need to understand consumers' needs, behaviors, and preferences. What we did was to sponsor a consumer pulse survey of over 70,000 consumers across 12 markets. And this was done very recently. We started May 2020. And some of the insights for the next 3 slides, this will be short, Malu. The cutoff is as of August 24, 2020. You will see here on the slide the typical purchase drivers for consumers. The pyramid here, you will see on the base, value for money, not a surprise there. Ease of buying, relatively expected. But the third one, personal safety. From this list, we then asked respondents this question: which of the following is important to you now when buying a product or a service? The percentage refers to the proportion of consumers who rate each as important in their decision making. You will see here that personal safety is now a new consumer expectation that is perceived to be very basic, alongside value for money and buying and ease of buying. These basic needs must be met before consumers are able to consider psychological needs such as greater customer experience or the needs of others. So based on this, you can conclude that organizations must work much harder to reassure potential consumers that their personal safety is paramount and find new ways of engaging them to ease the anxiety around in-person interactions. So this is pretty consistent with the current implementation being done by BPI. The reach that it has achieved in terms of consumer engagement has been pretty impressive. So that was very interesting earlier, Bob. And something more specific to banks. On the next slide, you will see here that banking customers more than ever want to feel in control. Hopefully it's visible enough. They want to be equipped to make sensible decisions about their future, and they want to proactively have communications to help guide them on their way. So based on this, it is more critical than ever for banks to have a deeper understanding of customers and offer more personal experiences. It is especially important to offer new and more complex services that were previously branch-based but now need to be delivered online. So based on this survey, even enabling customers to self-serve and solve queries more quickly can help organizations down costs by about 25%. And then moving on, we can see here the reduction of selected in-branch transactions, which in turn is replaced by a digital channel. Onto the next slide, please. You will see here the lines on the left side. These are the activities that are being done less and less in branch. So I think a lot of these are as expected. Checking of balances. For the past 2 months, within Asia Pacific, there has been a reduction by around 7% out of 70,000 respondents. And even managing their accounts, it has likewise been reduced by around 6%. And you will see here on the right side, the purple and the sky blue bars, the increase in activities being done through a bank's website or through a financial services app. I think that further supports the statements made by Bong earlier. And then lastly, what we've been doing on the next slide, what we've been doing is what are the important developments. So we've been a eye on the market, and then we've come up with for connected consumer. Number one would be companies need to see a customer as a place of business. A place of business is no longer the physical branch or physical location. So given that we are in an on-demand world, sellers of goods and services follow their customers wherever they happen to be. So the front office is digitalized, as mentioned earlier, and virtualized. Number two would be relevant, empathetic, real-time interactions. Engagement will be paced by the customer, who expects personal recognition and validation, as well as enjoyable engagements, and where real-time transactions happen and issues are resolved on a real-time basis. And then number three would be a rich, multi-channel, easy engagement environment. So while the underlying mechanics of the digital economy are relatively invisible to customers, it is now the organization's responsibilities to make sure to make it as seamless as it can. And then lastly, consumers are really after, and all of us can relate to this, we really are after solutions, not necessarily products. So the awareness of touch points has moved outside the enterprise walls into target markets. So there, hopefully I was able to add additional texture into the discussion. And I'll stop at that right now, Malu, and I'd be happy to participate in the panel discussion.
Thank you, Mike, and thank you, gentlemen, for your very interesting insights. We do have time for a conversation, so let's get right down to it. And I have my first question to Bong. Bong, in your digital journey, can you share with us the flip side of digital transformation? What are the unintended consequences to your journey?
Well, accidents is the flip side. I mean, any time you rework a incumbent system, especially one that you've had where additions have really been bolted on over 10, 20 years, you're really dealing with the potential for accidents. And so we saw that in 2017 when we had our little glitch episode. We've seen a couple of smaller versions of that. Most of the time, 90% of the time, it's invisible to the customer. But these things do come out. Now I think we're past most of that, but that is the flip side.
What about unemployment? The profile of your employment for employees, for example.
It's really only now that the issue of of digital vis-a-vis branch staffing has come to the fore. You know, I was looking at FT this morning. They had an article saying that Deutsche Bank is going to close 1 out of every 5 branches in Germany. I'm looking at our situation here, and I don't think we'll get to that stage. And the reason I don't think we'll get to that stage is because what we're seeing, especially given the state of our economic progress in the Philippines, is that as people do more digital, they want more service and they want more advice. And the best example of that is with the sales of our insurance products. More and more of which are being sold digitally now. And yet our insurance companies are staffing up because people are looking for advice.
Okay, thank you. Let me just move on to Oleg. Oleg, can you just talk about the technology divide? Particularly, I think, in the Philippine context, where on one hand, you have the older members of the labor force who usually would lack the capacity or even the desire to access new technology versus the younger members of the labor force who grown up in this technological age. So how does the future of work that you envision play out in this kind of technology divide?
Yeah, I think, Marilu, you're hitting on an important topic here. Clearly, the divide exists in terms of the skills, given the experiences and the intergenerational gap that you described. I think it is important that both individuals as well as the employers take care of making sure this divide is bridged. Older employees, they bring a lot of other useful skills to the workplace. They have experience, definitely with the years of work, they have more maturity in judgment. Typically, their social skills are more polished because of the amount of human interaction they had throughout their lives. So upskilling them on technology can actually be very beneficial to the business because they can act as coaches and mentors on all other useful skills which the millennials may not have. And I do think it's important to some extent. It's a responsibility of the employers to think of that, as well as responsibility of individuals, but at least they should be provided with an opportunity to upskill.
And in your case, Bong, in your case, how big a problem, or was it a problem? I mean, you're an older bank, and so was this a problem for you, a technology divide between your older employees and your younger millennial employees?
No, I don't think so. I mean, we haven't seen that technological divide in our workforce. And maybe we're lucky that our older employees are actually quite adept. And to be honest, we haven't seen that technological divide in our customer base. In COVID-19, some of the most aggressive people, the segment that aggressively signed on for our digital offerings were the older segment. Where we see the technological divide, Marilu, is in access to smartphones. Right?
Okay.
As long as you have access to a smartphone, you can function in this world. If you can't afford a smartphone, that's where you see the divide.
That's interesting. Let me segue into something related to that, and I want to talk about culture. And Bong, you're over 100-year-old bank, and interestingly, I read an article of McKinsey, Oleg, and sometime in September, and they did a survey, and more than 50% of those who were surveyed said that they were planning large-scale changes in their organization because of the desire to develop speed that would allow them then to adapt to changes in their strategic direction, deployment of resources, or the implementation of tactical decisions. In your case, Bong, how difficult, if it were, or it is the speed by which you could change processes or culture? Did you need to do any changes or adaptation in your culture? And did this impede the speed by which you could effect innovation or change?
Well, you know, if you look at our bank today, vis-a-vis where we were 7 or 8 years ago, we're twice as large. We have almost twice as many people. We are more digital now than we were back then. But I think it's a mistake to say that these last few years were unique. I think the reason we're a 169-year-old bank is because we've actually managed to change with every generation, right? It's just now that the change looks more profound. The pace of it is probably faster because of digital, but we've changed a lot. I think every new management team has brought tremendous change. I mean, remember where we were when we were without ATMs, and all of a sudden we had ATMs. Remember where we were without cash acceptance machines. All of a sudden we had cash acceptance machines, and now it's digital. So it's par for the course.
So you will disagree that age and scale and flexibility or agility are necessarily one being an antithesis of the other. That
No.
You could have age and scale and be flexible and agile at the same time.
Yes, I think as a matter of fact, what you're seeing in the last few years is you're seeing big tech co-opt fintech, right? Big tech, you know, the banks are co-opting fintech. So,
and talking about fintech, so you do not see banks losing a lot of ground to what are perceived to be more nimble, more technology driven, and maybe less regulated fintechs?
well, the fintechs have made gains in the payments and remittance space, right? But as a percentage of the total wallet that's available in the finance industry, it's a small percentage. The big value drivers still have to do with loans, still have to do with investments. And there, the track record of fintechs is very, very mixed. As a matter of fact, I suspect COVID-19 will even delay that kind of move. The ability of a fintech to get into the lending business, for example, so far as I can see, it's only been proven in China in scale. Everywhere else, it has not been done in scale.
So would banks and fintechs be, traditional banks and fintechs, would they be natural adversaries, or can they actually be partners?
What we're seeing now, if you just look at the number of our APIs, is we are co-opting fintechs. We're bolting them on.
Okay.
Right? We are bolting them on.
Yes, okay, good to hear that. Let me just go back to Oleg. Oleg, almost 99% of business establishments in the Philippines are MSMEs, and about 70% of employment is really from this sector. How does your view of the future of work relate to this kind of business and employment profile?
It's an interesting question. I think the changes which are happening throughout the economy will definitely impact this sector. So if we look, for example, at the small shops, the more progressive of them are already present at online e-commerce platforms, selling their wares to consumers all the way across the Philippines, and not only in the area where they are located. And clearly, these are the small guys who will have advantage over other small guys. They may never compete with the large established retail players, and maybe with the passage of time, as we know, retail tends to consolidate and modern trade takes over. But nonetheless, being able to operate in this new digital world is something which, before crisis, I would say could create sustainability for them. And now in the crisis, those who ended up online are actually reaping benefits of being the movers in that space.
So there is actually benefit to being MSME in this kind of environment, especially with the pandemic.
There's a benefit thinking about what am I lacking in terms of my skills, and how can I upskill myself, even if I have a one-man shop. Definitely there's benefit to that.
Okay, let me go to Pupi and Mike, and I'm interested to know how different your digital transformation journeys are or is, with Mike being in a service business and Pupi in a brick and mortar operation. So are there very distinctive differences in your approach to your digital journey? Let me start with Pupi.
Well, in our case, you know, the automotive industry specifically in the Philippines has remained relatively the same for many decades from the 90s. I think one of the things that the pandemic has really forced us to do is to reimagine how we can interact and serve our customers better. There are certain basic things that you still have to do on site. For example, the repair of a vehicle, depending on the size of the repair, more often than not still has to be done on site. But even having said that, we are imagining and actually even doing off-site repairs already to a larger degree than we used to before. Even basic things like assisting customers who may not be as comfortable moving around, or maybe they're senior citizens who are deciding to comply with lockdown restrictions but need something done, right? If they're interested to take a look at the vehicle, we bring the vehicle over to them so that they can test it. Sometimes if they have service requirements, we can come and pick up the vehicles as well. I think one of the other things that we're also looking at is, we basically have two sides of the automotive business. We have the distributor importer business, and we also have the brick and mortar dealership business. And dealerships have traditionally been very capital intensive. They're large. They occupy a lot of a lot of real estate space, right? And because of the competition, because of the number of players that have entered the industry, the margins have declined, as Bong also mentioned, similar to banking. And there is a very real need to reconfigure the economic equation for dealerships. And so the questions naturally arise: do you still need these big dealerships in the future? Will you still need these big dealerships when your customers more and more will start interacting with you on digital platforms, right? And may only come face to face with you for certain segments of the actual transaction. This presents opportunities, obviously, to bring your costs down if needed. In our case, we are a multi-brand business, and therefore the specific company that I lead, Iconic Dealership, started out as a wholly Volkswagen dealership business. Today, we sell Volkswagen, Maxus, and Kia vehicles in almost all of our sites. So these are, I think, the things that are welcome changes, welcome opportunities, and I think there's more that we need to do, really, to position ourselves to better serve our customers. At the end of the day, that's what it is, right? Customers are going to want to feel safe. They're going to want to have ease of transaction, convenience, all those things. And that's what we keep in mind as we try and redesign our processes.
Mike, you have some thoughts on your own digital transformation journey?
Yes, Malu. So essentially, as you mentioned, so as a services company, we are not capital intensive. So that gives us more flexibility as far as having the ability to try to pivot from one priority investment to another. So we don't have to wait for full depreciation of specific capital expenditures that were previously expended. And then number two, in terms of age, for a regular services company like KPMG, where out of a 1,500 sized firm, average age is 26. So in terms of embracing the digital tools, all of the user interfaces, I mean, that was pretty easy. So as far as personnel was concerned. And then going now to our ability to service clients, right now we're both a user of digital tools as well as a service provider. We give advice. Our IT advisory group provides advice to different companies. So it has been a balancing act, how to make sure that we're always ahead of the curve to ensure that advice or support to clients remain to be ahead and relevant. And then at the same time, making sure that our personnel are likewise trained up as far as those items are concerned. So, and then connecting that to what you mentioned earlier. So definitely, since we're not capital intensive, the challenge was how to ensure that the, the culture would then accept this new way of doing things, putting in place the proper governance within the organization, and noting that we are one of over 200 KPMG firms around the world. So having to work within that overall structure was very interesting and likewise very satisfying for us.
We're supposed to end at 11:30, but I hope you will allow me to extend a little bit just to cover a few questions that are, there's a long list of questions here, but let me just very quickly choose those that may not have yet been covered. This is a question that this is for Bong. Is there some thrust to significantly lower or eliminate fees for InstaPay transfers? Just a yes or a no?
No, I think what's happening now is you're going to have some banks charging from October 1. Some banks will continue waiving fees until the end of the year. But by January 1, I think everybody will be charging fees.
We'll have to go back. Yes, okay. Here's another question. Again, this is for Bong. When you discuss the future of branch banking, how will this impact your manpower? Will there be job losses? And how do you help your workforce transition from branch banking to digital banking?
We want to minimize job losses. And the way to minimize that is to be able to convert traditional branch bankers into sales folks, into advisors. And if we can do that properly, we can minimize job losses.
Okay, thank you for that. There's a question here. I think this must be for Oleg. What's your view on the short-term and long-term prospects of co-working spaces like Accelerate and Common Ground? How should their business models change?
I would not be in a position to comment on specific co-working establishments. But as I said, from our discussions with the company, is 80% are looking at some hybrid models, and 20% more of the companies which are purely on the tech side are looking at fully remote mode of working and using co-working spaces for special events or team meetings where the face-to-face time is needed. So clearly the trend to more shared real estate will continue. As I said, I would not be in a position to comment on a specific establishment.
Okay, here's another question. The problem with the Philippines is that digital transformation. Let me rephrase it. The problem with the Philippines, digital transformation is a challenge because, with some exceptions, C-suite leadership sees digital transformation as a prohibitive cost and not as a competitive game changer. The CTO or CIO is not part of the C-suite unlike most global corporations. This is from Tony Boyong Shapo. Please comment, Bong, very briefly, and then Oleg.
Actually, digital transformation lowers the cost to serve. The upfront cost is expensive, but if you look at the benefits and you amortize the cost over time, it's a fraction of actually doing it another way.
Looking at it, taking a longer term view. And Oleg?
Yeah, I would add to what Bon just said is that the digital transformation also allows improvements in customer experience. And to some extent, it's also a bit of the Red Queen phenomenon. If all of your competitors move onto digital and you don't, you get left behind. Think Blockbuster versus Netflix. So there is a case in most situations, positive case for digital transformation. The question is over what period of time it'll pay back.
And then Malu.
Mike, you wanted to say something? Go ahead.
Yeah,
sure.
Definitely part of the assessment that has to be done would be how mature a company is, how ready it is for digitalization. And one of the aspects of that maturity assessment is whether the chief technology officer is indeed part of the small decision-making group of that entity. So that is a key differentiator or thing that must be in place for a company to, push its digital strategy forward.
That's a very good point. Thank you, Mike, for that. As always happens with very knowledgeable and very articulate speakers and panelists, the time allotted for our conversation is never enough. So but before we wrap up, I'd like to ask all of you gentlemen, very briefly, what is your big window of opportunity in the next normal? We'll start with Mike, then Pupi, then Oleg, and then Bong. Very briefly, short and sweet.
For me, Malu, it's the ability to reach customers easier. There's less need to travel overseas, to wait for a bus, to wait for a plane. Now it's so much easier to connect. And the challenge is the substance that you will be discussing with clients and colleagues.
Okay, thank you, Mike. Pupi?
Mine would be, it's the opportunity to reimagine your businesses in ways that you may not have previously considered. The reality of where we are today has brought us to the point where I think we all accept that we're not going back to the way it was in February of this year. Things will have to change. And either that will be because we're forced to, or because we also just embrace the window that has been put before us to start and explore, as I said, new ways, new models. And if before we were hesitant, then maybe now we have a little bit more courage to try new things and to think out of the box.
Thank you, Pupi. And Oleg?
I'm
Your
excited
big
about
window of opportunity?
I'm excited about an opportunity to convert the skills of your labor force into strategic competitive advantage. Now what has happened is the location of work has become disconnected from the benefits of hiring talent. So you can hire talent regionally, you can go hire talent globally. And also the digital disruption is forcing many companies to upskill and reskill their labor force. And those who will lead with this will reap large benefits.
Thank you, Oleg. Bong, final word.
Yes, as we go through our digital transformation, we're going to find ourselves being able to touch more people because we will reduce our cost to serve. We will become a much more financially inclusive BPI. And I think everybody benefits from that. Everybody will benefit from a more financially inclusive banking system.
Thank you. You painted a very exciting future for all of us, something to look forward to, even as we grapple with the pains of the pandemic. So let me thank all of you gentlemen for your generosity in sharing your time and your expertise and your insights into how we should reimagine the future and lead through the unknown. Let me now call on Ned Goseco, the chairman of our Professional Development Committee, for his closing remarks. Ned?
Thank you, Malu. It's certainly been an interesting morning for all of us, and I need to wrap up, but I guess I'd just like to go straight to the point of thanking our distinguished speakers for this morning. Bong Singh of PPI, Oleg Timchenko, of course, our panelists, for sharing their great insights. As well, of course, our host, Ms. Malu Cristobal. Of course, special thanks to Ayala for their continuing support. And finally, to you, our participants, for attending and joining us in this summit. Please join us again for the final series of the Ayala-FINEX Summit on September 28th at 10 a.m., where we will feature TG Limcaco of Ayala and Dulicia Calisoria of Deloitte, who will talk about alternative strategies and why corporate focus has to change. Thank you once again and enjoy the rest of the day. Bye.
Thank you, Ned. Thank you to all. And we will see you next week for the third part of the summit. Stay safe, everybody.
Thank you, Malu. Thanks, Bong.
Thank you. Bye-bye.
Thanks,
Thank you,
everyone.
Malu.
And
Thank you, Malu.
Pupi and Mike.
Yeah, thank you.
Bye,
Thanks for the
TG.
opportunity.
Thank you.
Thanks, Tej. Thanks, Omar.
Thank you. Thank you, Mike.
Partner, salamat. Thank you.
Thank you,
Ned,
Thank you, Bong.
Ned, we have
Thank
a
you,
whole
Oleg.
up next Monday.